This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, July 31, 2026, and this is the New York session. Now, let's get into it. The US dollar is accelerating. Across the board, from the euro to the yen, greenback strength is dictating the rhythm of the New York session. With the fear and greed index plunged to 14 out of 100, capital isn't hiding in gold, it's running straight to the safety of the dollar. Turning to the calendar for Friday, July 31st, two key metrics land today that will test this dollar dominance. First, the University of Michigan Consumer Sentiment. Second, the Employment Cost Index. Both are critical gauges for the Fed's next move. Apex, what are we watching for in that data?
The Employment Cost Index is the immediate flashpoint. We're looking for wage pressures that either validate the Fed's hawkish stance or crack under the weight of slowing growth. If the data reinforces the sticky inflation narrative, it validates the current dollar bid. If it softens unexpectedly, it opens the door for the soft landing trade, which hurts the dollar.
Let's look at the snapshot as of 9:39 Eastern Time. The fear gauge sits at a deeply fearful 14 out of 100. The VIX is up 2.45 points to 20.66, signaling elevated stress but not panic. Yet, surprisingly, gold, the traditional fear hedge, is down 0.75% to 4,075.27. Meanwhile, the dollar is broadly stronger. Dollar-yen leads the charge with a 0.25% gain to 160.589. Dollar-Swiss follows up 0.12% to 0.806825. On the flip side, the majors are fading. Euro-dollar down 0.8% to 1.1514, and cable down 0.6% to 1.3452. First, the Fed's internal fractures are widening. Headline 2 reports that Fed's Kashkari and Hammack explain their dissents at the last meeting, citing inflation too high. Second, we have the Eurozone pushing back. Headline 6 notes euro area inflation nudges up in July, keeping pressure on the ECB. And third, the BOJ is reacting. Headline 11 quotes BOJ Governor Yuta saying he will conduct monetary policy in a manner so as to not fall behind the curve. It means the soft landing narrative is losing ground to a higher for longer reality. Kashkari and Hammack aren't whispering. They're shouting that core PCE at 3.29% is unacceptable. That anchors the Fed funds rate at 3.63% with zero expectation of imminent cuts. It forces the market to price in U.S. yields staying elevated, while the ECB is paralyzed by data dependency. And on the other side of the Atlantic, the ECB is trapped. SPECTER, you see a disconnect in the safe haven flows regarding these central banks.
Exactly. Look at the VIX. It's at 20.66, rising. Usually that screams buy gold, but gold is falling to 4,075.27. Why? Because the fear isn't driving money into commodities, it's driving it into dollar liquidity. The safe haven bid has rotated entirely from metal to the dollar, leaving the yen and euro exposed to policy lag.
So we have a U.S. economy that is printing sticky inflation and a Europe that is seeing inflation nudge up. CIPHER, what does the positioning data tell us about who is getting caught in this crossfire?
The CFTC data from July 21 is screaming imbalance. Leveraged funds are net long yen by 1,209 contracts, a massive weekly jump of 97,394 contracts. That is a crowded trade waiting for a trigger. Simultaneously, they are net short Canadian dollar by 98,377 contracts. The smart money is structurally underweight yen and Canadian dollar, betting on dollar strength despite the short-term volatility.
Let's dive into euro-dollar. It is trading at 1.1514, down 0.8%. Grid, what are the chart structures telling us right here?
Price is hovering at 1.1514, which puts it squarely beneath the 5-day high resistance of 1.1537. We've got a 5-day range of 1.13533 to 1.1537. The fact that we're touching the upper band of that range after a pullback suggests we are hitting a ceiling. Today's low is 1.15063, so if that support breaks, we're looking at a retest of the lower bands. There is no breakout momentum here, it's a distribution pattern.
Grid, you're seeing distribution, but I'm seeing who is holding the bag. While leveraged funds have piled into long euro plus 1,209 net, asset managers, the big allocators, are net short 3,290. Speculators think it's going up. Institutions are hedging against it falling. That institutional overhead makes 1.1537 a formidable brick wall.
It's more than a wall, CIPHER. It's a policy trap. With Italian CPI holding at 2.8% year-over-year, the ECB cannot hike without killing the economy, but they can't cut without ignoring the data. So the euro is stuck in a policy limbo. The higher for longer U.S. yield differential crushes the euro's appeal. Any bounce to 1.1537 is just liquidity traps for shorts, not a trend reversal.
And let's not forget the volatility risk. The VIX is expanding. At 20.66, the standard deviation of moves is wider than usual. A fake out above 1.1537 is highly probable in this regime. If that happens, the subsequent liquidation of those leveraged longs will be violent. The risk isn't just direction, it's the speed of the unwind.
Moving to the biggest mover of the day, dollar-yen. It's up 0.25% to 160.589. Grid, walk us through the levels here.
This pair is a mess. We had a massive 570 pip swing on July 30, dropping from a high of 163.74 to a low of 157.9655. Now we are recovering to 160.589. That puts us right in the danger zone between the intervention low of 157.9655 and the psychological resistance of 161. The daily candle closed in the lower quartile, H 160.883, L 160.145. That tells me the bulls are weak. We are consolidating, not attacking.
Weakness is dangerous when you're holding 97,394 newly accumulated yen longs. If dollar-yen breaks 161, those longs don't just hold, they implode. The positioning data suggests that a break above 161 doesn't just push price up. It forces a cascade of covering that accelerates the move. But until we clear 161, that crowd is sitting on thin ice.
CIPHER Grid, let's synthesize this. Grid sees the 161 resistance as a technical barrier. CIPHER warns that breaking it triggers a squeeze. Pulse, the macro backdrop, supports dollar strength via the Kashkari descent. The synthesis is clear. The yen long is a liability. The probability leans toward the dollar testing 161, and if it holds, the squeeze begins. However, SPECTER, you flagged intervention risk earlier. Where is the floor?
The floor is 157.9655. That was the intervention level. But the real risk is the stealth intervention mentioned in the headlines. The BOJ is watching. If we see a vertical spike in volume at 161, that's not organic buying, that's manipulation. The risk here is asymmetric. The reward for a break above 161 might be high, but the risk of a sudden regulatory clampdown bringing us back to 158 is non-trivial. We are walking a tightrope.
Let's pivot to commodity currencies. Dollar CAD is at 1.4018, up 0.4%. CIPHER, you mentioned Canadian dollar shorts earlier. What's the setup there?
Net short 98,377 contracts. Asset managers are also net negative. It's a double-layered bearishness. Unless oil surges, which it hasn't, the structural position favors dollar upside. The setup is simple. Short Canadian dollar on rallies, provided global risk appetite doesn't suddenly return.
Technically, dollar CAD is testing the 1.4 integer level, sitting just above the 5-day low of 1.39909. If 1.4 fails, we retest the 5-day high of 1.41291. Given the heavy shorts, that failure is likely. It's a classic break and chase scenario.
And remember, Canada is tied to the U.S. economy. With U.S. unemployment at 4.2% and GDP sluggish at 1.5% annualized, the BOC has less room to maneuver than the Fed. The spread between the Fed funds rate of 3.63% and the BOC's stance continues to widen. The math works against the loonie. Finally, let's touch on cable. It's at 1.3452, down 0.6%. Grid, quick read.
Mid-range consolidation. Today's low is 1.34451, 5-day high is 1.34769. No clear direction, it's waiting for the BOE decision on August 6th. Until then, it's noise, I'd skip it.
Agreed, cable lacks the structural imbalance we see in yen or Canadian dollar. No massive crowding, no institutional scream, just wait and see.
Summary for pound, stand aside. The other three tell a much clearer story of dollar dominance.
Apex tie it all together. We have Fed dissent, sticky euro inflation, and crowded yen longs. What is the unified picture for the rest of the session?
The picture is unilateral dollar strength, but with jagged edges. Pulse correctly identified that Kashkari and Hamak's dissents anchor the higher for longer narrative, making euro-dollar's resistance at 1.1537 a sell zone. CIPHER highlighted that the yen long is a loaded gun. If grid's 161 resistance breaks, the squeeze is inevitable. However, SPECTER rightly cautions that the 157.9655 intervention floor remains the ultimate cap on upside. The trade is long dollar against yen and Canadian dollar, but size cautiously around the 161 yen barrier. For euro-dollar, fade the bumps to 1.1537. The data supports the greenback, but the volatility, measured by the 20.66 VIX, means we must respect the whipsaws.
To recap, the U.S. dollar is commanding the market. Fed officials are warning of sticky inflation, pressuring the euro to hold below 1.1537. The yen is dangerously crowded, with yen longs poised to unravel if 161 breaks, though intervention risks loom at 157.9655. And Canadian dollars face structural headwinds with heavy short positioning. Keep an eye on the employment cost index later today. It could cement this trend. Stay disciplined, manage your risk, and we'll see you next time on ShadowQuant Forex Edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.